Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello and welcome to the Stock Play of the Day. On this week's Stock Play of the Day, we are going to be looking at option strategies for the year end. I'm Brian Overby. I'm the Senior Options Analyst at Ally Invest. And before we go too far, though, we're going to take a quick peek back at Boeing. We talked about Boeing. The defense stocks in general were in the news a lot this week. Plans of a new bomber and a couple of other defensive names. Boeing isn't necessarily a defense stock, but obviously it's important for the national defense. The ability to make planes does matter. So we're going to go back and last week's trade worked out just fine. Had a big run up and actually more volatility than anticipated, I would say, because of the news headlines that we saw last week in Boeing. As far as the markets are concerned, we'll start out by looking at my VIX watch list, and we see that the markets have been really choppy. I think everything is going to be about the CPI number that's going to be coming out on the Wednesday at before the open, and that's what that inflation number is really 1,947. We're down 51 points on the day, and we got the VIX index up a little bit. We were down around 20%. Now we're at about 1.27%. So we're seeing a little weakness in the market. We've been talking about the retail customer for quite some time, and the news was a little mixed over the holidays, but definitely not bad. Not 100% rah-rah, like, oh, yay, the retail consumer is spending a ton, but definitely better than anticipated. So that kind of propped up the market. We had the fact that many people are saying that inflation may have peaked. We have the fact that the retail customer, Black Friday and Cyber Monday, were fairly decent from some of the marketers that are out there. The retail salespeople. And now we're just hoping that news, especially with the CPI, stays the same, shows that we are trending to the downside. The markets, specifically the CME FedWatch tool, is really bouncing back and forth between if the actual marketplace thinks that the Fed will raise interest rates by 50 basis points or 3/4 of a point. When we saw some hot jobs numbers, we actually saw the Fed Watch tool say that there was over maybe about a 31 or 32% chance that they would do a 75 basis point hike. Now that we're getting into some more data on the economy and what's going on, came back down to about the 25% level. So it's still not off the table. And as far as the Fed is concerned, they've been a little bit less hawkish, Jay Powell in general, about needing to go faster. And that's part of the reason why we're looking at about a 70% chance of a 50% basis point hike. But if we do bump up to that 75, I obviously think that that could be a headwind for the market. We're hoping to get that Santa Claus rally. We're hoping that the retail customer will come through for us and be the good spot in this marketplace. But that's been the real stronghold as far as the economy is concerned. And it has a lot to do with the fact that unemployment is still at very low levels. We're seeing really good wage growth, which is good for the consumer, good for Christmas. Johnny's still going to get his favorite toy, it looks like, but it's bad as far as the Fed is concerned. The Fed sees this as this is adding to the inflationary numbers, and everything's going to be about that CPI number. What we really need is that market CPI to continue this trend to the downside. And if that does happen, that will actually be a very strong thing for the marketplace. So S&P 500 index down 1.3%. That's nothing to sneeze at. NASDAQ is down 1.7%. Russell 2000 is right around where the SPX is at. And we got the VIX coming up a little bit. Heading into, we're mid-December. A lot of times the retail sales numbers are out mid-December. Sometimes we do get some choppy markets. Then we're hoping for that Santa Claus rally. Now, we have had, I can't remember, I guess it was 2 or maybe 3 years back now, where between Christmas and New Year's, usually there's, if anything, it's uneventful, but we had a couple of big down days. And the market, if you were on vacation and came back, the market was back to good levels very quickly. So hopefully we don't get anything like that this year as we head into the holidays. All right. So I always like to talk about this topic at year end. We looked at Boeing last week, which is a fear of missing out trade. Now we're going to talk about a couple of stocks that have done fairly well. ExxonMobil, some of you pick your energy stock. As always, we're not here meant to make a recommendation, but stocks that have had good gains, maybe you wouldn't mind selling them. Maybe you want to take the capital gain in this year, 2022, as opposed to next year. Or maybe you have a capital loss that you would like to take. I'm thinking of some of the tech stocks. Meta for sure, most people would probably have a loss in. And one way to sell a stock and bring in some income above and beyond the sale of the stock is to look at covered call writing, and specifically more at the money covered call writing, because you're looking to get rid of the stock. And the fact that we have the VIX and the volatility index trading above 20% implied volatility, which seems to be here to stay. I'd say 20% in this day and age is considered low volatility. So we're around 22% on the VIX. A lot of these underlying stocks, especially these tech stocks, are trading at 30, 40, even 50% implied volatilities. There's some premium to be had by selling call options. So if you're considering trying to, quote unquote, clean up your portfolio or get ready for the year end, obviously the year end is big as far as taxes are concerned. We're not here to give recommendations on taxes, but everybody pretty much knows that, as I approach the year end, I want some things to happen. I want some stocks to be sold, some stocks to be bought, some stocks to just stay where they're at. And so we're going to look at a couple of strategies. I'm going to start by just talking about the good old-fashioned covered call, probably the most used option strategy in the options marketplace, in that all you're doing is you're selling a call at a higher price than where the stock is currently trading at. So that's going to be our strike price. And you're saying that if the stock gets to that level, you can take it away from me. You're getting paid now for saying you're willing to sell that stock at a later date. And like I said, there's some juicy premiums, so we're going to look at a couple of those. And then we're going to actually talk about, well, maybe I have some juicy premiums in a stock like ExxonMobil, which was going to be our stock today. And but I'm just more worried about the downside, because the energy stocks have had a good run up. And, and right now, the energy crisis is still real, especially in Europe, but they're doing better than anticipated as far as the markets are concerned. So let's start by looking at the Boeing trade from last week, which was a fear of missing out. And I think the fear of missing out trade was really what has driven a lot of the rally. When they see the SPX, I think 4,000 is a big level, just mentally, nice round numbers. And I don't want the SPX to continue on up and I miss out on the bounce back. So I think that had a little bit to do with fueling the rally. Now we're seeing a little bit of a sell-off on that. As I mentioned, in mid-December, it's not uncommon to have that happen as far as seasonality is concerned. So on the Boeing chart here, this is a 5-day chart. So it covers over a week's time. So, five trading days is what we're seeing here. And we saw that Boeing didn't make a strong move all the way up to 88, 188. Now we've seen some falling off, and this was actually a scary point here. When we broke through the 50-day moving average, we actually got a big down move in Boeing, and we're now back to 179. We're still up strong considering the short time frame that we're looking at here. But with that said, we obviously got a little top heavy here. Going back, this was on the 5th at 11 o'clock on the 5th is where we're seeing that high that was hit. Looks like, right around 11:15. And so the option that we looked at was a February 17th 150 call going out 80 days in time. The market was at 174.14, 174.14. So the trade, and I'm going to run over to the options playbook and try to find the trade here. 1 second. And we'll just jump into the rookies corner. And what we looked at doing is buying a leaps call as a stock substitute. We didn't use a leap. A leap would be, leaps is actually the correct way to say it because it's an acronym. Leaps would mean that you're going out over more than 9 months in time. We're going out here 80 days, so a little bit of a longer term option contract, just going into the next year. But we're buying a lot of delta, and it highlights it here in the rookies corner how you might want to use this strategy as a substitute for owning the stock. Limited and known risk on the downside, but a lot of stock price representation because we're going deeper in the money, buying an option contract that has a high delta, which means that if we got a delta close to 80, if the stock goes up 1, your option contract should go up about 80 cents. Another way to say it is you get 80% of that stock price movement. Now, this is relative to 100 shares, right? If you had bought 100 shares of stock went up 1, you would make $100. If you bought this option contract that we're going to look at here shortly, and the stock went up 1, you would make $80. So many different ways that you can talk about delta, but it's just important to understand the concept so that you have a realistic expectation as to what your option contract can move based off of a 1-point movement in the underlying stock. All right, so here's Boeing. Here's the December expiration. All right, thought I had that expiration up, but I don't. Here we go. February 17th, 150 call option. So we need to go down a little bit, and we are down 3.5% today. So we're at the 150 strike call. I'm still not there. Must have been on the other chart. The 150 strike call, we see it trading at 28.90 by 29.60. When we went and we did this trade, even though we got the stock up a little bit, we were trading right around that $30 level. So it would be more so that we'd be looking to stay the course. We still have high implied volatility on it. No, that's not right. Yeah, that doesn't make sense. I'm in the December expiration. That's why. 1 second. There we go. That makes a lot more sense. Okay. So we're up a few dollars. So this actually, let me just put this into the option trading strategy. Okay. So the stock was at 174 is where we were at. And right now the market's at 178.58. Okay. So stock went up $4. We bought this option contract for right around $30. Midpoint was right about $30.30, according to my note. Right now, we're at, let's call it $34, right? So the stock's up $4. You would have made over $4. We were 174.17. We're at 178.71. So it was over $4. You would have obviously made that $4 on that stock if you bought 100 shares of stock. That would have been over $400 since we put this trade on. So now we look at the 150 strike and we see that it's 330 by 334.45. And we talked about this on last week's show, in that if the markets were as tight in the deep in the money option contracts as they are in the stock, almost everybody would be doing this strategy as an investor. You have limited and known downside risk, but the battle is that you're always dealing with wider bid-ask spreads, and wide enough that it really does matter. So in this instance, 33.70 on the bid, 34.45 on the ask. That's a fairly wide bid-ask spread, trading at around 50% implied volatility. We mentioned that. Still a very high level. Part of the reason why we're going to look at selling some call options in ExxonMobil. But in this instance, we see this. Let's call it 34, right? So we put the stock on for 30.30. If we could sell this for 34, it's showing you that we are getting a good amount of that stock price movement. And that's what our goal was, right? Made over $400 on the stock. We're making about $400 on the option contract. We're showing the delta right around 83 cents. Delta was, I think, 79 when we put on the trade. So we're picking up delta. We're picking up shares of stock. You could say, if your forecast is correct on this underlying, it's going to act more and more like the stock. The delta is going to get higher and higher. And you see that if we go deeper and deeper in the money, delta gets higher, you get more stock representation. And the only downside is that you're going to have to deal with, as you get into more and more expensive options, you got to deal with wider bid-ask spreads. Okay. You're up on that position. We still have out until February 17th, 73 days remaining. We started with 80 days. What could you do? You could sell a call against this position if you would like, or you could just sell that option. You could go out and sell it, especially when you saw the big run up in such a short period of time. If I jump back to the chart real quick, all the way up, I'd say right around here when we broke through the, through right here, we had the 20-day moving average. And when we had that strong move and 20-day actually kind of held right here, then we saw this parabolic move up all the way from 182 all the way up to 187. Selling somewhere near that, obviously, in hindsight, would have been solid. Definitely would have considered selling when we had a solid breakthrough right here in the 20-day moving average, and definitely when we saw this right here on the 50-day moving average. Okay, so if you're just looking at moving averages and looking at the charting features, these would be some points where I may have sold because I had such a good run up. Now, our goal was to be a little bit more long term. So I don't mind at all that you're holding onto this position. We talked about on the downside where we would want to get out, but right now we just have a little bit of weakness in the stock. We had a little bit of strength back here based off of the news. So when we're looking at this trade, that's how we want to consider. 174 is where we're at. This is where it is. Okay. So if I'm looking at this trade, I'm okay with being a little bit long this option contract and staying out closer to that February 17th expiration. There's no concerns with it whatsoever. If you want to try to do it off of charts and you want to close this position, what you'd want to do then is come in and say, all right, I am long one Boeing February 17th, 2023, 150 strike call. I would click trade and I would do the exact opposite. Instead of buying to open, I would do a sell to close. I'd pick a limit price. I'd say 34 would be pretty solid right now if I could get that. And I would be looking to close my position at $34, selling to close the February 17th expiration 150 strike call at a limit price of $34, and that would be good for the day. And that's how I would try to work this order. Not a bad market right now. 33.95 by 34.20. So maybe you could even get 35.05 or I'm sorry, 34.05 or 34.10. That might be feasible right at this point in time. Okay. So if you have any questions about last week's trade, please put them in the chat box right now. I'm going to address them at the very end of the show, but I want to get into today's trade. And today's trade is I just want you to look through your portfolio as you're calling through your portfolio, thinking about what I want to do before the year end. covered call writing is a very interesting trade to do on stocks that you are willing to sell. So if I go back to the chart and I don't think yet that's going to be my change. So let me pull up this chart on ExxonMobil, and I'm only picking ExxonMobil because it is one of the sectors that has done well year to date. And we've shown a little bit of weakness. As a matter of fact, if I just look at this chart right now, you see the 50-day moving average. We had the breakdown from the 20-day, and we're hanging out right at that 50-day moving average. So there is some weakness recently after this is year to date. So a very solid run up in ExxonMobil, and also with a lot of other energy stocks too. I just decided to pick ExxonMobil just because it's a $100 stock. It's one that you might consider selling some calls on. And we are seeing some weakness in the stock today to go right along with the marketplace. So what would we look to do? Here would be our strategy is we're just going to do a good old-fashioned covered call. If we own that stock, sorry, didn't mean to touch my mic. If we own that stock and we sell a call against it, all we're saying is that if the stock goes a little bit higher, we'd be willing to sell it at that higher price via the call option. So my intention would be on stocks that I want to take the gain before the year end. That's what I'd be looking to do with this strategy. If I want to go out further and I want to make the gain go beyond, then what we're going to be looking at is a collar situation. I'm trying to bring in some premium to help me sell this underlying stock now. But if I wanted to try to push this off into maybe the next year, looking at a January or a February expiration date, we're going to be looking at doing a collar. I would sell a call to buy a put to give myself some protection. So there's two different ways to approach this. Let's start with the first one, the covered call option. So ExxonMobil right now is there. We have a lot of different expirations to choose from, but it's kind of nice that we could do a December 30th expiration. Then that means that the underlying stock would be sold and it would settle before the year end. So if we did the December 30th expiration here, and we are at the 104.30 is where the stock is at right now, $104.31. Remember, you would have 100 shares of stock in your account. Maybe you have some capital gains. You wanted to take it in 2022 as opposed to next year. My biggest thing about this is if I am looking to sell, I want to sell something very close to where the stock is at. So if the stock's just above 104, I'm going to think about selling the 105 or the 106 strike call, depending on how bad you really want to sell it. So I'm going to look at the 105 because I'm saying I really want to sell this underlying. And I see that I can get a decent market. For every 100 shares that I have, the market's 305 by 320. I'm going to click on the bid. That actually would put it right in the right rail. And I'd be looking to sell to open one contract of the December 30th expiration, 105 call option at a limit price of, well, we'd look at, I'd probably say 310. Let's make it 310. And my hope is that I can sell this at that strike price at 105 on that expiration date of December 30th. And if you're not looking to do that, if that's not your goal, well, then I might not do this strategy if I'm not willing to sell the stock. Now, if I look at this and you say, well, Brian, what if the stock goes down? Well, it is a risk. That's your downside risk here, is that if you would sell the stock right now, you would get 104.29 and you'd just be out and you'd move on. If we do this, we got to hope that the stock continues on up to the end of the year. We get assigned at 105 and we collect the $3.10. So this would be bad news if the stock went down to 100 because it would go down more than the premium that was received, and the strategy would backfire in that instance, right? Because, well, why wouldn't I have just sold the stock at 104.20 where it's at right now, as opposed to hoping that I get assigned at the 105 strike and actually get it called away? Okay, so just a difference. If I'm doing covered call writing and it's in a stock that I like and I own, a lot of times I might go further out of the money. If I was hoping to keep the underlying stock, I'd maybe even look at a 106 or maybe a 113 strike right here. Well, what did I say? 106, 111. I'm bringing in $1 in that situation. or 113, I'm still getting 60, 70 cents. These options are all trading right around that 30% implied volatility, so you're still getting a lot of juice for these option contracts. And that would be my approach. If I wanted to try to keep the stock, I would go further out of the money and sacrifice some of that premium. All right, so now let's say that we have the stock and we don't want to take that capital gain, I'm assuming, because by looking at the chart, in ExxonMobil. So what could I do to try to prevent it? Well, now we're going to look at the collar strategy. And it's very similar to the covered call, but instead of bringing that premium in and pocketing it and putting it in your account, we're going to actually use the premium to buy a put and give us some protection on the downside, saying that we don't want to sell the stock right now, but we're a little bit worried. We see that, well, we see the chart that we're bumping up against. I think was that the 50-day that we're bumping up against. And now I'm just a little bit nervous about what's going on with oil in general, energy markets on a lot of these stocks. There's been some weakness recently. Why not think about putting on a collar? So how would that work? Once again, don't forget, you have 100 shares of stock. You own this stock. You have at least 100 shares. You might have 200 shares. Who knows? But you have at least 100 shares. If I have 100 shares, I'm looking to sell one call option, saying that if stock goes up, I'll be willing to have the stock called away. And I'm going to buy one put option. But they're all going to be in 2023. Okay, so how does this work? Here's my expiration date that I chose before we got rocking and rolling here, the January 20th, 45 days, obviously in 2023, and that's what's important to me. So I'm going to go out that far in time. I'm going to scroll down a little bit from that December expiration. And our goal here is usually to try to get it done for a zero cost. So I'm willing to give a little bit of upside. I want the stock to run. So I'm going to look at buying the 115 strike call, which is about 11 points higher than where the underlying market is at. And then I see on the downside, on my put option, I want to literally just go down and see where I can actually pay for the put. So 115 on the upside. On the downside, I would be looking at the 92.50 strike. And notice the ask here is 123. The ask here is 120. So I'm selling the 115 strike call to help pay for my protection on the downside, which would be the 92.50 strike call. Going to go out until January, 45 days out. And I'm just saying that I want some protection in the marketplace, but I don't want to pay for it. So I'm willing to give up some upside opportunity to help pay for my protection. So a collar actually looks like this. We would be selling this call, buying this put, and we would, if we had 100 shares of stock, we would be buying it on a one-by-one basis. Oh, I sold the wrong one. All right. And notice we'll be very close to zero. Net debit of 4 cents to the account on the midpoint where we're at. So, and if I'm doing this trade, one of the risks that is a real risk, and you'd want to consider something with this, is if the stock did run up too fast and you didn't really want to sell it right away, and it went to 115. So you can adjust that call option. You can either consider closing out the position. You'll still have upside on the stock, and you still have a gain on the stock. You'd have a loss, obviously, on the short call option and the long put. Or I can look to roll my covered call position. And how would I roll? Well, if you do get to 115, inside the options playbook, we have a section that is called Managing Your Position. And in here, introduction to rolling, it talks about covered call writing, cash secured put selling, and what I want to do or consider when I'm getting close to my strike price on my covered call option. And if you click on the next one, you actually get into the rolling of the covered call and gives you a bunch of things to think about. All right. Speaking of things to think about, any questions that we have in the chat box, please put them in right now. I'm willing to answer anything that you might have. We covered a lot of things. Boeing was definitely an interesting trade from last week. And, it's always straightforward. Nothing's ever meant to be a recommendation, but it really is. That was a fear of missing out trade. Market, especially stock like Boeing. Uh, there's a lot going on in that company, but stock was poised to maybe make a run, and it did make that run, and then it came off. Stock is very volatile. Hard to just go out and buy the stock. Why don't we buy that option contract deep in the money, get stock representation, but still limit our risk? So far, so good on Boeing. This week, this is all about cleaning up your portfolio before year end. If you are thinking about stocks that you'd like to sell, stocks that you'd like to protect, stocks that you'd like to try to put off maybe a capital gain till 2023, or that you want to take a capital loss or a capital gain in 2022. These are two very pertinent strategies to consider if you're option curious going into the year end. All right, well, I don't see any questions in the chat box, so that's going to be it for this edition of the Stock Play of the Day. Please click subscribe, ring the bell, and please smash that thumbs up. And please share this, share all the information with the Stock Play of the Day with everyone you know. It's available to all, and we do want to make this an interactive event. So the more and more that we interact in the chat box, the happier we are. Thanks for coming, everyone. We'll see you the same time, same place next week.